Steve Hanke is back. He is a professor of applied economics at Johns Hopkins University, a globally renowned economist, expert on monetary policy, among many other things. Welcome back, Professor. Always good to see you. It's 2 weeks before the election. In case we don't talk before the election, it's very possible we will, but just in case we don't talk before the election, I'd like to ask you what's on your mind, first and foremost. As an economist, you're looking at a lot of things, you're well versed in a lot of things. The election has become an economic issue. And in fact, according to a lot of polls, uh, the economy is the number one concern for voters this year. I think immigration is number two, depending on which poll you're looking at. What needs to be changed in the economy, Professor? It doesn't matter who wins. Why is the economy such a big election issue this year? And what needs to be done to make the average American life better?
First of all, let's talk about the election prospects briefly. Uh, if you look at what's happened in the last month and a half, and you look at the polling numbers, gradually Trump's come from clearly behind to even or maybe a tad ahead. Now, those are subjective, the polling markets are. Well, if you look at objectively at what's going on in the betting markets where people have skin in the game, and you get an objective market indication of the probability of winning, Trump has come from behind to with considerable lead overall and in these swing states. So it appears that there's quite a bit of momentum behind Trump. So at this stage, that's what it's looking like. I tend to look at the betting markets, the so-called prediction markets, because they are objective and reliable and more accurate than the polling data. And the reason for that is, of course, people are betting real money when they're engaged in those markets. It's a little bit like the stock market. You know, the stock market, we got all kinds of analysts who have subjective ideas about what the value of a company should be or a stock. And there are thousands of them. But what happens with the market, it accumulates all that subjective information and like a magnet sucks it in, and you have buyers and sellers then who actually want to engage with their own money in either buying or selling, and what you end up with is the market price, and the market price is the price. It's objective, it's no longer subjective. It's the aggregation of all those subjective values and valuations into one objective number. And that's what goes on in the betting markets. It sucks in all these subjective views about Harris or Trump, and you end up with a probability. And so that's why I tend to look at those. Now, getting to your point about what needs to be changed, or why people, let's first tackle why people are worried or anxious about the economy. It's clear we've gone through an enormous roller coaster in monetary policy. We had this huge increase in the money supply after the pandemic hit, and then that was followed by a huge increase in inflation. Then the Fed switches into reverse, and we've had this huge contraction in the money supply, and we have coming slowdown in inflation. So money supply goes way up, inflation goes way up. Now the money supply comes down and inflation starts going way down. And I think people are worried, at least I am. I think we'll have a recession because of this contraction in the money supply. So that roller coaster ride effect of the money and monetary policy is one factor. The other factor, I think people intuitively they're worried about this free spending in Washington, expansion of government deficits, huge deficits. a huge accumulation of debt, and that worries them because that they know if they're running their household or business, that's not the way it goes. You go bankrupt eventually, and basically that's what the Congressional Budget Office has told us. They've indicated that the level of debt in the United States is not sustainable, and interest rates are interest expenses, I should say, are going up faster than anything else in the budget, and now interest expenses are actually greater than defense expenditures and Medicare, and the total debt is 35 trillion. Okay, that's a big number. It's over 100% of GDP. But if you look at the unfunded liabilities, those are about 4 times higher than the stock of debt. It's about 120 trillion. Those are promises that have been made that when I say unfunded, they haven't been funded. Taxes haven't been collected to make those payments on those promises that are already in the book. So we have a huge debt and deficit problem. And I think the third thing that generally kind of bothers people is that they realize that more and more of the power to make decisions about the economy are in the hands of politicians. In short, they're in Washington, D.C., instead of being in businesses and corporations and private households. So I think in general that's the main thing. The roller coaster in monetary policy, huge expansion and uncontrolled government spending that everybody knows can't continue. And if it can't continue, David, it'll stop. And people know that to stop it, how do you stop it? Well, you stop it by increasing taxes, direct taxes, or inflation taxes, one of the two.
Are you liking this video so far? Well, video creation is challenging. So let me tell you about today's sponsor, InVideo, which is changing the game for video creators like me. And if you're a content creator, then listen up. I know that creating videos can be complex, but InVideo AI V3 changes that. With new generative capabilities, you can now create full-length, publish-ready videos from scratch using simple text prompts. Whether you're telling a story, explaining complex topics, or creating product ads, InVideo AI V3 puts you in control, bringing your ideas to life in minutes. Unlike tools like Sora and Runway that only generate clips, InVideo V3 creates entire videos ready for use, and the best part, it's launching in just a few weeks. With the edit command box, you can make real-time adjustments to your videos, plus voice cloning now lets you replicate your voice for narration. If you haven't checked out their current version, scan the QR code here or use the link in the description down below to try it for free. Paid plans start at $20 a month, so use my code to get 2 times video credits in your first month. Get started today. I'd like you to grade the economy over the last 4 years, please. Take a look at this article from CBS News. Americans say the economy is a top election issue. This is from a week ago. Here's how economists are grading it. By many measures, this is the article, I'm just reading it. By many measures, the economy has regained its footing. Emerging from the health crisis with the type of growth that is experienced prior to 2020, GDP is growing solidly, while unemployment and the labor market have also rebalanced, remaining close to their pre-pandemic levels. Critically, inflation has dropped to a 3-year low and is approaching the Fed's annual target of 2%. Here's a quote from Mark Zandi, chief economist of Moody's. In the 35 years I've been an economist, I've rarely seen an economy performing as well as it is. I'd give it an A+. I've actually interviewed Mark Zandi, and he's made a number of pretty good points, I would say, for why the economy is doing well. We're looking at the same data. How can we interpret this differently here?
Well, I think, obviously, if you've got money and got money in the stock market, it's doing very well. There's no question about it. And however, if you look at the median wage, the real wages adjusted for inflation have gone down. So that's another reason people are worried. It's a pocketbook thing. if it, this gets back into the monetary policy thing. If you goose the money supply, what happens? With a lag, asset prices go up in about 1 to 9 months. Well, the stock market went way up. Real estate went way up. If you own stocks and you own real estate, you made out like a bandit. But what if you didn't? Well, you didn't do very well because inflation was eating away at your wage more rapidly than your wage was going up, and you actually were getting behind the curve. So you got if you go down lower on the wealth specter, you find that uh, it doesn't look so great. The middle class and lower middle class and low income levels are behind have retreated. Now,
Yes.
if you look at the billionaires, by the way, which I've done, the billionaires share. If you look at the total wealth of billionaires relative to GDP, it's gone up. Their share has gone up. So it's just been great for billionaires. There's no question about that. I think a little bit that this reading of the economy being so great is it's a little bit the tooth fairy. If you really get under the hood and you start looking at it carefully, it's been good for some, but not so good for a lot of people. And that's why a lot of people are complaining about it.
Here's what you're referring to, Professor. Distribution of household wealth in the U.S. since 1989. This is from the Federal Reserve. This is breaking down household wealth by wealth percentile group. So in the top 1%, their wealth has increased. The top 0.1% has increased. The bottom 50% has stayed stagnant, and the 50 to 90%, which is the majority of the population, their wealth has increased in nominal terms from $43.37 trillion in 2022 to 47.55 trillion today, Q2
Yeah, but
2024, which is
that's true. But that's you had the right word there. You said nominal. It's
yeah,
not adjusted for inflation.
no. But the point stands that their wealth has increased less than those of the very wealthy, which, of course, as you know, is correlated with financial assets. Like you highlighted, what can be done, Professor, is a question to
So,
help those people in the bottom half, like the dark blue line and the yellow lines here.
what you've got to really go back to, and everybody knows this. Everybody should know it. You've got to go back towards more of a less government, more free market economy, more private sector, more deregulation, and a key is stable monetary policy. Why have the rich gotten so rich during in this period of Bidenomics or the post pandemic period? Because of the Fed. It's all placed on the Fed. The money supply should be growing. Hankey's golden growth rate, consistent with a 2% inflation target, it should be growing at about 6%, steady 6%. Well, at one point in 2021, and remember in February, it was growing at 17% year over year. That's a record. That's the highest it's ever been. And now it's dropped down to about 2%. So this is a roller coaster.
Mm.
You've got to get back to monetarism and the quantity theory of money and steady monetary growth. That is one factor. Then the next thing is more free markets. But what we've done, we've adopted industrial policy. We've adopted an approach where Washington's going to be making more decisions about how capital is allocated and how the economy runs than in the past. So that's bad. We're basically copying, I like to say, we're copying China. We're copying the Politburo. That's what the Politburo does. The Politburo calls it shots in China. And we have formally by the way, about a year and a half ago, the Commerce Department under Biden actually came out with a statement that we are adopting formally industrial policy. Now, you look at the two candidates, and what are they talking about? A lot of industrial policy, all this tariffs, protectionism, managing the economy.
I don't think I've ever asked you this, Professor, but if you were president, what would you do? First changes you would make that would better the economy?
Well, I'd go back to the playbook that we had in the Reagan administration and just implement it. I just go back to Reaganomics.
The left keeps arguing Reaganomics doesn't work. Trickle down doesn't work. You don't get wealth trickling down from the top.
Well, it did work.
Okay.
That's a little what I call bull dust. The record, you've got to look at the facts, and the facts are Reaganomics turned around stagflation. When Reagan came in 1980, we had stagflation. He turned that around, and what happened in the 1990s was largely a result of what was set up by Reaganomics in the 1980s. We had a tremendous decade, and what we had, by the way, a big peace dividend in the 1990s with the defense expenditures coming down. Now they're going up.
Let's talk about the 80s for just a minute. How much of the end to stagflation was due to Reaganomics versus Volcker's policies? Let's give credit to
Volcker's policies were part of Reaganomics.
I see.
But Reagan gave Volcker the green light to introduce, again, monetarism. The idea that changes in the money supply influence economic activity and inflation. And that was Volcker. He kept his eye on the money supply. Now we have a Fed chairman who doesn't keep his eye on the money supply. He's disavowed monetarism. He's disavowed the quantity theory of money. He says that the changes in the quantity theory of money don't have a connection with economic activity and inflation.
You were a senior economist.
By the way, it's just nonsense.
You were a senior economist. We should remind the audience, you were a senior economist for the Council of Economic Advisors during the Reagan days. Can you just tell us, back in those days, what were some of the key issues that the economists of the Council of Economic Advisors were trying to address?
Okay. Well, the first thing was getting inflation down and giving Volcker that green light to practice monetarism. So that was one big thing. The other thing, Murray Wiedenbaum was the chairman of the Council of Economic Advisors at the time and a big expert on regulation. And so deregulation, we kept that moving forward. And I might add, that actually started with President Carter. Carter started some of the deregulation, airline deregulation thing, natural gas deregulation. Some of those things came in early, but we kept the momentum up and accelerated that. So the deregulation started. Then we get into a sticky wicket, and that was protectionism and trade. And the picture there, although Reagan talked the talk about free trade and anti-protectionism, elements of the Congress and the Republican Party, remember then the big enemy was Japan. Remember that? Japan was causing all these trade problems with the United States. So the United States put in a variety of protectionist measures, which I was against, the council was against, but the Commerce Department was for them. And ultimately, Reagan had to eat crow and introduce some of these things. And remember the voluntary restrictions on importation of Japanese automobiles. This goes way back. Well, that's like a quota restriction. And of course that actually backfired. That it ended up being a great deal for Japan and a bad deal for the United States, because Japan, they did meet the quotas and restrict the number of Japanese cars coming into the United States, but they only sent high valued cars. Expensive Toyotas were coming into the United States that had very high margins, and the Toyota was making out like a bandit. so, so the trade grading I would give us was kind of mixed, maybe a C plus or C, something like that. Deregulation, very high grade, A. Monetary policy, A or A minus, and free market generally. Just the thinking about it, thinking that way, was A. I mean, the message Reagan was delivering was A. Now, what do you get? What do you get with Reagan? He was saying Washington is not going to solve your problems. Now, what do you get? Washington is going to solve your problems.
Okay, I don't want to get sidetracked for a minute, but since you brought up cars, I want to talk about trade with China. I wonder if there's any similarities between now and Japan. Take a look at this article. I read this morning. I had a good laugh. This is Ford CEO Jim Farley praises Xiaomi SUV. Xiaomi, as you know, is a Chinese tech company. He says to a magazine, "We flew one from Shanghai to Chicago, and I've been driving it for 6 months now, and I don't want to give it up." This is the CEO of Ford. As you know, there's a 100% tariff, I believe, on Chinese cars. What should the next administration do about trade with China? And I'm just taking the cars as an example, right?
They should
electronics, the tech is.
they should eliminate the trade barriers, and China would eliminate the trade barriers.
So if they do that, we get the Xiaomi cars and the BYD cars and whatever. That's going to lay off a lot of American jobs, is the argument, right or wrong?
Well, that's the argument, but why should we be against if we have a buyer and a seller, and let's say you want to sell me something. David Lynn wants to sell Steve Hanke something, okay, and Lynn and Hanke agree on the price of whatever Lynn's gonna sell Hanke.
Yeah.
Why should the government come in and step in and say, "Oh, you can't do that," or alternatively, they come in and say, "Oh, you can do that, but we're going to charge you a tax of 100% on that." This just doesn't make any. Why should politicians be deciding those kinds of things?
Let me just. This is a very interesting philosophical question. Let me just throw one more variable at you. Suppose you and I, Hanke and Lynn, come to a private agreement. I sell you something and you buy it. But suppose if you buy this product, your friend Jim from down the street loses his job. Would you still buy it?
Yes.
Okay.
If we agreed to the transaction, why you're talking about all kinds of hypothetical external things that go on. By the way, one thing that
because your friend Jim down the street used to be supplying this to you. Now I'm getting it to you at a fairer price and perhaps a better product. So Jim loses his job. You like Jim. You don't want Jim to lose his job.
Well, let's go to the reductio absurdum kind of argument then. Then, yeah, in that case, if you follow this line of argument, you would just close out all trade with you'd become an autarky.
Okay.
Trade with nobody. Then Jim's going to be okay. Okay. Jim might be okay, but you might not be okay, because whatever Jim is producing is going to cost you a lot more, and you're going to have less money. So there are all kinds of these indirect effects that run through the economy. The main thing is, if you want prosperity, you've got to let markets function. That's the point. And let's now talk a little bit about trade and these trade imbalances and what people don't understand. Why did Japan have such a huge trade surplus in the past? And they had it because they saved a lot more than they invested, and the U.S. saved a lot less than they invested. So we had the deficit, they had the surplus. It's just the arithmetic of the thing. Now it's shifted. China is the big one. China, they save a lot in China, and they save a lot more than they consume, and that means that they have a trade surplus. Switzerland does the same thing. They have a trade surplus because the Swiss save a lot more than they invest. And the deficit countries are just the opposite side of the coin. The US, the reason we have all these imports, by the way, if we wanted to solve this problem with Jim,
Yeah.
let's talk about Jim. Let's talk about all the Jims.
Yeah.
If we wanted to attack that, we would balance the federal budget, because the savings in the economy, the reason that savings is a lot less than investment, it's because of the federal deficit. That's why we run year after year since 1975 trade deficits and current account deficits. I don't think that's a very interesting thing to be targeting, but the reason why we do that is because of the federal deficit. Now,
Yes.
if you get rid of the federal deficit, by the way, the trade deficit will shrink. So if you were really worried about the trade deficit and foreign trade and foreign competition, the best way to cut that down would be to reduce the federal deficit.
By the way, the CPO was projecting the federal deficit to widen to, I think, 6.9% of GDP by 2034. Yes, but 2034, that will equal roughly 40% of all income from revenue. Sorry, all income from taxes, personal taxes. Okay. Now, is there a relationship between deficits and economic growth? If you look at the past, let me just show you this chart, for example, here, Professor. This is the federal surplus or deficit. I'm actually going to show this as a percentage of GDP here. Percentage of GDP. If you look at, this is from the St. Louis Fed, deficit as a percentage of GDP has been slowly but surely widening over the last few decades. Has that had an impact on growth? I mean, the economy has been growing despite this widening deficit.
It hasn't been growing as fast.
Okay.
And look at the look at the boom years when. Let's talk about this in concrete terms, because you got these lines up there. People are looking at that saying, "What in the world is that?" You know.
Yeah. Okay.
Now, let's talk about the most fiscally conservative president we've had since World War II is who? It's Bill Clinton. And remember, Bill Clinton in the 90s, he actually ended up with 2 years of we were running surpluses.
Yeah, that's here.
See that thing? You see that right there? Yeah, right. Okay. So those years they were squeezing the deficit out and ending up with surpluses, and we had pretty strong growth. It turns out that the potential growth rate in the U.S. is actually sliding down a little bit. And it's sliding down because of what? Because of government expansion, squeezing the private productive sector out of the economy. That's one reason it comes down. And associated with that, in a concrete way, well, there are more and more regulations. Just think of all the regulations. Think about building a house. Why are houses so expensive now? You've got 10 million regulations you've got to comply with that add tens of thousands of dollars to the price of constructing a new home. It's just due to building standards and regulations. That's just one example. But the whole idea is, do you want someone in Washington making decisions for you and the economy when those people don't pay the cost of making bad decisions? In the private sector, why does the private sector work as well as it does? Because they're in a profit and loss system, and if they screw it up, they make a loss, and they might even go bankrupt if they make too many bad decisions. In the public sector, that doesn't happen. You can make one bad decision after another, and it doesn't make any difference because those bureaucrats and politicians really have no skin in the game.
Do you
They're
think
not
Congress should
operating.
have
They're not operating in a profit loss system.
Well, do you think Congress should have a target for the deficit to GDP ratio, like the Fed has a 2% inflation target?
I think here's I'm actually on the board of something, an organization called the Federal Fiscal Sustainability Foundation. And what we've been pushing on is a convention of states under Article 5, which there are enough states since 1979 to actually do this, and focus on changing the Constitution and putting in something like a Swiss debt brake where the government expenditures could not go up any faster than the economy grew. Now that means that the size of the government relative to the total size of the economy would stay the same. The 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 government couldn't crowd out the private sector. So that's happened in Switzerland, by the way, in 2001 when they changed their constitution. The other thing is that the budget would have to be balanced. Two things: the growth in government spending could not go up any more rapidly than the growth rate in the economy. So you keep the relative size of the government the same and constrain it. And the other thing is this rule that the budget would have to be balanced. So that would solve the problem. But you have to do it with a constitution. We've tried to do this in the United States with statutory changes, but in the law. But those are really kind of band-aids that eventually tear off after a couple of years and the thing falls apart.
This is a rhetorical question, of course, but why would politicians purposely change the Constitution to handcuff themselves on how much they could spend?
Well, you would have in a convention of states, by the way, the states would be voting on whether they change the Constitution or not. And they do it for the same reason. In Switzerland, they have referenda, Switzerland. So the voters actually directly voted. And they over 80% of the Swiss voters in 2001 voted to put in the Swiss debt brake and change the Constitution. And why did they? Because they saw trouble coming down the road if they left the politicians to freewheel. They wanted to put them in a straitjacket.
Okay. Speaking of sustainability of debt, let's take a look at what's going on here. The IMF published a report this week warning, this is from a CNBC article summarizing this report, warning that the public debt situation worldwide could be more dire than most think. Skyrocketing fiscal deficits from China and the U.S. are contributing to this rising global debt, which they project will reach $100 trillion by the end of 2024. They forecast global debt will reach 100% of world GDP by the end of the decade. Here's a quote from the IMF Director of Fiscal Affairs. Public debt may be worse than it looks. Governments are facing a fiscal policy trilemma. Per the report, they are caught between needing to spend more to ensure security and growth, but are also facing resistance towards higher taxation while public debt levels become less sustainable. What's your reaction to this? Is this noteworthy? Does this
matter to us? Yeah, it's the same thing as the Congressional Budget Office report that I said. These things aren't sustainable. The only problem I have with the IMF, you note his solution is more taxes. Mine is less government spending.
Okay.
In other words, the IMF, they don't like the deficits, they don't like the debt, but their solution is always to increase taxes. And that's why every country that goes into an IMF program starts running into this tax increase thing, and actually growth slows down because all the IMF programs are simply fueling a growth in government by increasing increase taxes, or you end up with tax revolts like we recently had in Kenya. You know, Kenya had a huge tax revolt over the summer because the IMF said as a condition for IMF money coming into Kenya, they had to increase taxes.
Right.
So the government says, oh, yeah, that's a great idea. Well, the public didn't like that very much, and ended up with you had riots in the streets.
Yeah. Can you just
and the government backed off, by the way.
Can you just educate us on the theory behind lower taxes and growth? So suppose we have lower taxes, more growth. Okay, fine, I get that. What if we take the extreme hypothetical example where we have no taxes at all and maximum growth in this case? How will the government make money?
That isn't exactly how it works. But right now we've got government spending. You're missing some factors in the thing.
Okay.
You like to go to these reductio absurdum things and get people tangled up so they get completely lost by the time you're done. but let's get real. And getting real is now the government in the United States, all branches of government take up about 35% of GDP. I think the ideal, all the government services that we need could be very well provided if we were between 10 and 15% of GDP. Now, that would be a huge reduction in government expenditures. It would also be a huge reduction in the tax burden on people. So we would have more money to spend and invest as we saw fit, rather than having the government spend it the way they want to spend it. And by the way, one reason that the taxes are so bad, there's something called deadweight loss. To collect a tax and administer the tax collection and the programs that are going to be used to spend the tax, as well as the distortions put in the system by collecting the tax, it costs about $2.65. In other words, if this idea people have that if the government, they say, oh, David Lynn, really, he's a worthy person. He really should be in a subsidy program. We should be transferring income from Hanke to Lynn. And most people think, well, if they take $1 out of Hanke's pocket, the dollar is going to go into Lynn's pocket. No, it's not. It doesn't work that way. It costs $2.65 to take it out of Hanke's pocket to end up giving Lynn $1. So it's a very costly program. Taxes are tremendously costly, and that's why lower taxes in a broad range end up stimulating things. They end up being good because you get rid of all this deadweight loss associated with collecting and administering the taxes and the distortions they cause in the economy. Every dollar of tax revenue actually costs $2.65 in the U.S. once you include the deadweight loss.
By the way, I've heard from some people that a rising deficit and or debt levels, they're going to be inflationary long term. Is that true?
Well, it may not necessarily, no, because if the Fed monetizes the debt, and the Fed is one buying the treasury bonds that are issued to finance the debt, if the Fed buys it, that increases the money supply. It's monetized then, and that will increase inflation. If not, if the Fed doesn't buy it, the money supply doesn't increase because they sell the bonds to Steve Hanke and David Lynn, and what happens? We pay for it with a check, and that reduces our checking account, and that reduces the money supply. It doesn't increase. So it depends on what is happening to the financing of the debt and who's buying it. If the Fed is buying it, it's inflationary. If the Fed is not buying it, it's not inflationary. It actually could be, if the Fed doesn't offset the reduction in those checking accounts that you and I have made when we bought the debt, if the Fed doesn't do anything, it's actually deflationary.
So it is possible for the deficit to rise without the money supply rising.
Yes.
Okay. Let's finish off on the economy for the US here. Are you concerned about inflation coming back anytime soon? I know you have a target for us, and I know the money supply isn't at your growth rate, golden growth rate yet, but Americans are concerned about inflation.
Yeah, they shouldn't be. The growth rate in the money supply now is 2%, and Hankey's golden growth rate, consistent with hitting a 2% inflation target, is 6%. So the monetary growth is very, very slow. The stock of money is lower than it was in July of 2020. Inflation is at 2.4%. It's coming down. I think next year it's going to be end up coming down below the target. I mean, it could very well by the sometime next year be down, 1.5% headline inflation. So no, and in the near term, I'm not worried about it. Now, why am I not worried about it? Because I know what's happened to the growth rate in the money supply a year ago, 2 years ago. It's coming down. So I'm not worried about it because you always have to look at what's happened to the money supply in prior months and prior years to anticipate what's going to happen in the future with the real economy and inflation. And I think due to this contraction in the money supply, we're going to have a slowdown in the economy. That's the real sector. And we'll continue to get a slowdown in inflation.
I want to close off on the BRICS summit that happened this week. Take a look at my screen. I'm not just going to read a few paragraphs from this. China, India, and border impasse ahead of likely Xi-Modi meet. So during the BRICS summit earlier this week, the Indian Minister of External Affairs met with the Chinese representative, and basically they agreed on a border dispute and resolved it. So just for a bit of context here, the relations between China and India have been frozen since June 2020, when clashes between soldiers along the disputed Himalayan border left at least 20 Indian and a known number of Chinese dead. Um, it says here the disengagement process with China, you can say, is completed. It's unclear as to whether or not this agreement on the border is enough to thaw the frozen relationship, but it is certainly a move in the right direction. It seems. What's your response, Professor?
I think it might be the biggest thing that came out of the BRICS summit. You see the BRICS, among other things, it's a good thing in the sense that diplomacy works. People are meeting, they're talking with each other, and it turns out you had what I call the big three, the three most important foreign ministers and most competent are Sergei Lavrov from Russia. He was there. And you mentioned the external minister of external affairs from India, the foreign minister, Jaishankar. He's a great guy. And then Wang Yi from China. So those are the three. Those are the only three foreign ministers in the world who I think are in the A club, and they were all at BRICS. So BRICS was important, and a concrete thing came out of it. They appear to have settled this border dispute, which is a big deal. Borders are always important. If you have a dispute about a border, you have a potential for a war. Why do you think we have a war in Ukraine? Because there was a border dispute. Why do you think really the Middle Eastern thing is flaring up? You have border problems. Who's going to control Gaza? Who's going to control the West Bank? What about the border between Israel and Lebanon? Those are all border things. That's where wars flare up, and we have one that looks like it was tamped down. You had other things in the BRICS conference that were, I think, important. One is that they're against sanctions. Well, I'm against sanctions too. It's a form of protectionism. They always backfire. They never work. So that was a big positive. They also, clearly supported the IMF, supported the G20, got out in the weeds on a few things like protecting big cats, tigers and lions, things like that.
What is going to change in the next 4 years the power dynamics between BRICS and the West, the next president has to deal with this.
My view is I think BRICS is going to become more important.
Yeah.
I think BRICS is going to be more important, and this there were a lot of things. They had 12 main points that they made. A lot of them were kind of general and you know and not very concrete. One of the 12, by the way, was to start a grain exchange, which I've worked a lot on, but it really it's kind of a hypothetical thing. They have no business plan. There's been no feasibility study. We don't know where the grain exchange would be located, but it's important because you got Brazil, China, India, and South Africa. Big grain producers. So that's something in the works, but it's just in the works. A lot of these things they're talking about are just in the works, kind of hypothetical. Again, back to the concrete, it's that India-China border thing as far as I can see. And a lot of, if you get the big three diplomats, foreign ministers at the same conference at the same time, plus heads of important states, I think that's good, not bad.
Well, I'm curious as to how military alliances may or may not shift in the coming couple of years. For example, North Korean soldiers were recently sent to Russia to fight the Ukrainians in the Kursk region. Now, it's no surprise that the North Koreans have aligned with Russia, but could we see more of that happening?
Well, we could if we get more sanctions. This is unintended consequence of sanctions. You get more sanctions and you get more of these unintended consequences. And sanctions, by the way, just for your viewers, if you look at the history of sanctions since World War I, they simply don't work. They're counterproductive. You put sanctions on somebody and it helps them and hurts you. You look at what's been going on, for example, the best example of this is Russia. We're putting all these sanctions on Russia. Russia looks like it's going to grow, according to the IMF forecast, 3.2% per year. The Eurozone is going to grow less than 1%. France, 0.7%. Germany, 0.2%. They're in a state of depression. Now, why? Because of the blowback from sanctions. They put all these sanctions on Russia, and of course, that cuts off goods and services that Russia was exporting to Europe. It hurts Europe.
Look, let's close off on this. This is what I was referring to. Okay, so sanctions have pushed North Koreans to do this. At least 3,000 North Korean soldiers arrived in eastern Russia this month. We assess that between early to mid-October, North Korea moved at least 3,000 soldiers into eastern Russia, National Security Council spokesman John Kirby said. We assess that these soldiers travel by ship. We do not know whether these soldiers will enter into combat alongside the Russian military, but this is certainly a highly concerning probability. We are seeing evidence that there are North Korean troops that have gone to Russia. What exactly they're doing is left to be seen. If they enter conflict with the Ukrainians, what's next? Can we speculate?
Well, the easiest way to stop all of this is number one, drop the sanctions and drop the. How many Western troops are actually in Ukraine? You know, they're going on and on about the damn North Koreans. I'd like to know how many Western mercenaries or incognito NATO troops are actually in the Ukraine. And we know, by the way, all the firing of any of these sophisticated missiles and so forth requires NATO guidance and backup. So this is kind of a game being played. To stop the war, the easiest way to do it is stop the U.S. funding of the war and come to the peace table and cut a deal and stop killing Ukrainians. Stop chopping up and destroying Ukraine. What's actually going on? You've got the destruction of Ukraine, and the numbers vary, but it looks like around 600,000 Ukrainians have been killed. My idea, the best way as an economist, if you want peace, the best way to do it is cut the funds off. It's like anything else. If you want to stop something, cut the funds off. If you want to stop a car, cut the gasoline off.
Yeah.
Or now that we have EVs, don't recharge the damn battery.
Who was it? I think it was Theodore Roosevelt. Yeah, if you the big stick policy from Roosevelt. If you want to prevent war, have a big stick, invest more in defense. What do you think of that? Does that work?
No.
All right. More on that next time, I guess. Thank you very much, Professor. This is an important talk right before the election, so I'm happy to have you do this with us. Where can we follow you?
On my Twitter, at Steve_Hanke, or send me an email at Hanke at jhu.edu, Johns Hopkins.
All right. We'll put the links down below.
And by the way, I this week, my most recent book I co-authored with Leland Yeager came out.
Oh, yes.
Capital Interest and Waiting. If you'd put that up on your site, I'd appreciate it. It's a great read. If you want to know everything about capital interest and waiting, you got it.
Capital Interest and Waiting.
Palgrave Macmillan is the publisher. The hard copy is out now. I just got my hard copies this week, and you can also buy that in the ebook.
There we go. Yeah, I'll put that link there. I'll put that in the description as well. We'll put a cover on the screen as well. Capital Interest and Waiting: Controversies, Puzzles, and New Additions to Capital Theory. We have to talk about that next time, Professor.
Yeah, we'll get into it.
All right, good.
You want, by the way, if you really want prosperity, you've got to put in institutional arrangements and incentives that encourage waiting. Now, what is waiting? Waiting means not consuming today and waiting to consume tomorrow. In other words, saving. And what's the price received for waiting? It's the interest rate.
Okay.
If David Lynn wants to wait and not consume today, or Hanke wants to do the same thing, we have to get paid an interest to wait. And why does that lead to prosperity? Because those funds that are freed up because we're not consuming something can be used to invest.
I think I follow, but more on that next time. Thank you, Professor. I'll speak soon.